Hello and welcome to our discussion on accounting, and the focus of our session today is to understand the cash flows and its effect on the financial statements. But before we get into the cash flows, let me recap that every business decision will find a place in the financial statement in the form of financial items. And the business decisions are operating decisions, investment decisions, and financing decisions. And the financial statements are balance sheet, income statement, and the cash flow statement. I'm saying that every decision will appear in the financial statement in the form of the financial items, and the financial items are, as per the conceptual framework, financial items are incomes, expenses, assets, liabilities, and equity, according to the conceptual framework of for preparing the financial statements. The all these financial items can be classified into financial incomes, expenses, assets, liabilities, and equity. And these financial items appear in the financial statements, in the balance sheet, or income statement, or a cash flow. With an example, we'll try to recap that. However, the focus of our class is to understand why is cash from operation is not same as PAT, and will the change in the accounting assumptions change CFO and PAT. But before we answer that question, let us understand the cash flows. We know that according to the accounting standard in India AS3, that the cash flows can be of three types, that is cash from operating, cash from financing, and cash from investing decisions. So it is necessary that while preparing the cash flow statement, we have to classify the cash flows into operating cash flows, investing cash flows, and financing cash flows. The investment and the financing cash flows can be found directly. But the focus, as I mentioned here, is to find and understand the operating cash flows. The operating cash flows can be found by using direct method, which answers what are the cash inflows and what are the cash outflows during the period. The cash inflows for the period comes from the cash sales or collections from the debtor, and the cash outflows comes from the cash purchases, payment to the supplier, or expenses paid. But this is a direct method which shows the inflows, the receipts, and outflows, the payments relating to the operations. But there is another question which is important for an analyst to understand. Why is cash not same as profit? That cannot be answered by the direct method. Therefore, the accounting standard says it is necessary to use the indirect method to to find the cash from operations. And the indirect method is generally recommended for showing the CFO. In case of an indirect method, the CFO is calculated by making the adjustments for the adjustment to the profit after tax, and adjustments are for non-cash items, non-operating items, and the credit items. In other words, the profit after tax is not same as CFO because of non-cash items, because of non-operating items, and because of the credit items which the firm undertakes during the period. So the profit after tax is calculated as per the generally accepted accounting principle, and that is calculated by using the accrual and the matching principle. So cash flow statement under the CFO has to be calculated by making adjustment to the PAT for non-cash, for non-operating, and credit items. Non-cash are common, popular, are the depreciation, the amortizations, gains and losses in the currency fluctuations. Non-operating, interest on loan, interest income, dividend income, and credit items are changes due to the working capital, which are increase and decrease in the debtors, creditors, stock, and other operating outstanding expenses. Let us take an example to understand that. So we have a simple balance sheet which shows the sources and the corresponding assets, and there are certain relevant transactions. Let us take it to the Excel. So this is the opening balance sheet which we have, and these are the transactions for the period. The transactions for the period are given here. So the transactions for the period will affect the balance sheet, in the process affect the cash flows and the profit for the period. So let us pick up one by one and understand the effect of the transactions on the income statement, cash flow statement, in the process the other components of the cash flow statements. So the first transaction, before we take the first transaction, let us put the cash, opening cash in hand 60,000, opening cash in hand 60,000. The sold goods for 150,000, sales is 150,000, and it is given that 20% of the sales is on 20% of the sales is on, let me show that, is on credit. So 20% of the sales is on credit, so that means 80% of the sales is for cash. So we get the cash inflow 120,000, but as a result the debtors will increase by 150 minus 120, so debtors will increase to the extent of the credit sales. And whenever there is a sale, there has to be the cost of goods sold, and the cost of goods sold is 60% of the stock, 0.60. As a result, the stock will come down to the extent of 78,000. That is the first transaction done. Salary for the period paid. So salary is an expense, 25,000, and salary is paid fully, so no outstanding, no asset, no liability, no asset. But if you see the rent for the period is 20,000, so the rent for a period is 20,000. However, you are paying rent 60,000, so there is an asset to the extent of excess money paid. If the payment is more than the expense, there is an asset. The collection from the old debtor 60%. Collection is a reduction of asset, not an income, so it is only shown in the cash flow statement, and the corresponding decrease in the debtors, so debtors will reduce to the extent of 15,000. We can see what happened to the debtor. So the debtor was 25. We sold goods for 150 minus 120 on credit, and you collected cash to the extent of 15,000. But the collection is not an income, it's a reduction of asset. Purchase stock for cash. We are purchasing stock of 40,000. This is an acquisition of an asset, not an expense, so the stock will go up to the extent of 40,000. No expense, but is an asset. Unexpired benefit is an asset, and COGS is an expired benefit. Interest due but not paid. Interest is an expense, and interest will be shown in the income statement on the bonds, 0.09. Interest is 0.09 of 25,000, but you have not paid interest, so there is an outstanding interest expense minus the payment is an outstanding. So therefore, if you can see that if expense not paid is a liability, and if the payment is more than the expense, then it is an asset. Purchase shares for 50,000 per 15,000 is an acquisition of asset, non-operating though, but it will be shown on the balance sheet, not an expense, because it's an unexpired benefit. It's going to create cash flows in the future. You purchase know-how. Acquisition of know-how is an asset, but it is amortized over a period of 3 years. Amortized over a period of 3 years. So therefore, know-how to the extent of 1/3 of this will be shown as an expense, expired benefit, and unexpired benefit will be shown as an asset to the extent of 16,000 is an asset. Depreciation for the period is 20%. Okay, depreciation for the period is 20%, and depreciation is calculated on the plant. So 0.20 is a non-cash item and is a reduction in the value of the asset. So the asset value will go down to the extent of depreciation. So we have taken all the items here. So we'll take the total expenses. The total expenses is 143,200. So profit before tax is 6,750, and let us assume the tax to be 20%, so 1350, and since we have sufficient cash, let us pay the tax. So profit after tax is 5,400. If no information given, we transfer the profit to the retained earnings. That means we are assuming that the profit is fully retained in the business, not distributed. Now cash in hand will be the total inflows 195,000, the total outflows 165,350. So cash in hand is 195 minus 165,350 is 29,650, and 29,650 will appear on the asset side. So cash comes from the cash flow statement, and the profit comes from the income statement. So income statement and the cash flow statement adds value to the balance sheet by telling us why the reserves or the retained profit is changing and why is the cash is changing. Now, no change in the capital during this period, no change in the bonds during this period, no change in the debtors during this period. So the total assets, the total sources are 272,650, and total assets will be also equal to 275,650. So these transactions has affected the balance sheet, and in the process the closing balance sheet has changed, the equity, the reserves have changed, and cash has changed, and the change in the reserves and change in the cash is visible from the income statement and cash flow statement. But this cash flow statement shows receipts and payment. What we are interested is to understand the CFO, CFI, and CFO. In this question, there is no cash from financing because you have not paid interest. So CFF is 0. CFI is negative because there is no inflow but an outflow of purchase of shares and purchase of know-how. And the CFO is positive here because it's a sales plus collection minus salary minus rent minus stock minus tax. We assume tax to be part of the operating. So so this one, finding the cash flows from financing, investment and operation is as per the requirement of the accounting standard. It is not enough to show that the receipts and minus payment is cash in hand, but is necessary to show the classification of the cash, whether it is from financing, whether it is for operating, or whether it is the investment decision. But the last question that we would like to answer is, when the profit of the firm is 5,400, the profit of the firm is 5,400, the profit after tax is 8,650. And as we discussed here, profit is not same as PAT because of these adjustment, non-cash, non-operating, and non-working capital, non-cash working capital adjustments. So adjustment for non-cash will take depreciation and amortization, so that because these have been deducted, so depreciation, add back depreciation 10,000, add back amortization of the know-how, and add back interest because it's a non-operating 2,250 interest we are adding back, but it is no tax adjustment done because the CFO does not require that adjustment at this juncture. Then working capital changes. The working capital changes are the changes in a debtor. In this case, there is an increase in debtor. Increase in debtors means you sold the goods on credit. So that means to that extent you have not received the payment. So minus 15,000. The stock, there is a decrease in stock. That means to that extent you have purchased the goods of the previous year which are sold in the current year. So therefore to that extent you have not paid money. So therefore it will be treated as an adjustment for the COGS which you have shown as an expense. Then creditor, there is no change in the creditor in this case, 10,000 minus 10,000, and there is an outstanding or advance rent, and the rent you paid excess, so advance rent 0 minus 40,000, that is minus 40,000. So if I sum this up, you'll get the cash from operation 8,650. Whether you do by the direct method, whether you do by indirect method, the cash from operation should be same, 8,650 inflows from operation minus the outflows from operation, or adjustments to the profit of after tax. So understanding that the transactions will affect the financial statement, and understanding the effect of the cash flows, effect of the transactions on the cash flows, and understanding the nature of the cash flows, and understanding why CFO not same as PAT was the focus of this session.